of course, we'll start with as you can imagine, an overview of NAFTA. What is NAFTA, and some general preliminaries about NAFTA. Then we'll get into the major objectives of the NAFTA. Then we get into the actual, if you will, subject matter in specifically the NAFTA rules of origin. Then we will get into, of course, the certificate of origin and some details, including my next point, how to complete the certificate of origin. That sometimes can be quite difficult for importers. Therefore, I have a few slides on some of the common mistakes that are made on the certificate of origin. Otherwise, we will say CO. And then, of course, because we are talking about compliance, we need to talk about some penalties for incorrectly completing the certificate of origin, whether by mistake or by fraud, which does potentially happen. Then, of course, the question of how does the various customs authorities verify your origin statements on the certificate, and we will discuss the Canadian, Mexican, and U.S. Customs authorities verification process. And then we'll get into some perhaps details of what are advanced rulings. These are statements, rulings by the three customs authorities regarding your future imports. And these are binding decisions which are made by the customs authorities, which, as you'll see, I, in many cases, highly recommend. And then finally, some conclusions, which I will keep fairly brief, given the time limitations that we have today. And then, of course, as has been announced, I believe, by Sean, perhaps, I will be here to take any of your questions or comments that you may have on the presentation, and hopefully I can comment myself or answer any of your queries. Thank you. So let's get into it straight away with my first subject matter slide. Overview of NAFTA. Before we get into that, we should demonstrate that a general point, under normal customs rules, you should know that imports are subject to paying tariffs or duties. These are, if you will, taxes that are given to the governments when imports are coming into a particular country. Those duties range from rates, excuse me, of up from 200% to duty-free. And when we say 200%, we mean the value of the goods, 200% of the value of the goods. However, free trade, in quotes, is trade without restrictions. That means no tariffs or duties on imports. And that's where we come to the main issue of NAFTA, because as we're going to be seeing, it is one of those free trade agreements that provide for restricting, actually limiting any restrictions, as well as providing for no tariffs or duties on imports among the three parties, of course. So here's a point of history. On December 17, 1992, many years ago, 26, I believe, Canada, Mexico, and the U.S. signed the North American Free Trade Agreement in full title. We refer to it as NAFTA. One of the largest free trade zones in the world. Yes, it is quite large, and we will get into some of the details of how big it is in relation to other regional trade agreements. Between 1993 and 2016, trade between the three members, let's see, I think I went to a slide too quickly. Let's go back. Let's just make sure. One moment, bear with me. The slide presentation is acting slowly. Up, down. Okay. Between 1993 and 2016, trade between the three members quadrupled from 297 to 1.2 trillion. So you can see from that fact that one of the major aspects of NAFTA, increasing trade between the three members, and in this case, in these brief period of time that we have such data, the trade between the three members, I should say among the three members, quadrupled from 297 billion to now in 1.2 trillion or more. Again, to put it into context, the U.S. trades more with Mexico and Canada than it does with Japan, South Korea, China, Brazil, Russia, India combined. So that's a huge fact demonstrating I would say, the enormity, the massive size of the NAFTA trade amongst the North American partners, especially when we consider the trade with the U.S. of all its Asian and South American countries. Elimination of import duties increases exports and imports. We know that as a general rule of economics, that if you reduce duties, or in this case, we eliminate duties, you will, by economic definition, increase your exports and imports within the region. The increased trade flows then lead to enhanced consumer choice, meaning you as a consumer have more, perhaps, imports. We love our imported products, so you have more choices of importing products, and therefore the thinking goes greater power as this more choices and likewise competition should drive down prices. And in fact, that is the case. This NAFTA has reduced prices, led to more consumer choices and competition, greater competition. So those are some very basic positives or advantages of NAFTA. Let's go through some others and perhaps even describe some of the potential negatives, if any, of NAFTA, because it is rather controversial at this point. The objectives are reducing trading costs. Yes, we know that is happening. Increased trade, yes, that's occurred. And investment. We won't talk too much about investment. Investment is a separate, if you will, topic, heading topic that we won't have time to get into, but I encourage you to, if you're interested in what we call FDI, foreign direct investment, that you consider looking into that. But we will focus primarily on trade. NAFTA eliminates tariffs and duties, as we said before. However, and here's where we get into the detail, it eliminates tariffs and duties on, quote, eligible goods, and that's a very important term, which we'll get into what we mean by eligible, shipped into the U.S., Canada, or Mexico, And main, very important objective of NAFTA is to preclude third countries, I should say also non-NAFTA countries, for example, Asian countries or countries coming from the European Union, the EU, from obtaining these tariff benefits by merely passing goods through North America. That means what has happened prior in the case that Asian or in some cases European companies have shipped products to Mexico without adding very much value and then re-exporting them to the US or Canada, as the case may be, while trying to obtain these same tariff benefits and not really adding sufficient value or content for North America by essentially passing the goods through Mexico, as an example, and then hoping to obtain these benefits. Well, that's not something that is allowable, and the rules of origin, which we'll discuss in detail, are intended to preclude these countries, these third countries, Asia and Europe particularly, from obtaining such benefits. And of course, we must talk about how NAFTA at the time, if you recall, was the end of 1992, many years ago, and the beginning of 93, when it was ratified. A main objective was to help North America, NA, be more competitive in the global marketplace. Well, what do we mean by that? That means if you know or you've read anything about what was happening in this point historically with regional trade in the early 90s, you will know that 1992 was the time of the European Union developing a major player and competitor with North America. And NAFTA was intended at that time not only to help, I should say, Mexico, Canada, and the U.S. in particular, but also to help North America maintain its competitive position in relation to what was happening in Europe. The European Union, also an extremely large and powerful regional trade bloc, came into existence also at the same time in the early 90s. Now let's get into the details of the rules of origin themselves. Again, imports into Mexico, Canada, U.S. obtain duty-free treatment only, and that's only, if they satisfy the NAFTA rules of origin, which we will discuss, both as they exist now, and I will also try to give you some brief update on the continuing, as you may know, negotiations that are ongoing as we speak today in Washington with regard to what we're going to do to, if you will, modernize or update the rules of origin. It's quite controversial between Canada, Mexico, and the U.S. But we will focus on the current, as they stand now, rules of origin. Well, what do these rules of origin do in detail? The rules of origin enable the customs officials to decide which goods qualify for preferential tariff treatment. That is the duty-free treatment, which of course is a preference against third country imports. It allows for duty-free treatment of the NAFTA products if they qualify. Otherwise, as I've said before, whether they're eligible. Important point of fact here, NAFTA origin today, as it stands, The rules apply only to trade in goods, not services. That may change in the future, because if you know anything about, I would say, American competitive advantage, it's primarily now in services. So we may see services down the road as part of NAFTA, but as it stands now and the continuing negotiations, NAFTA deals with goods. So if your company is involved to some extent on services, you should know at this point straight away that NAFTA does not apply to services as of yet. What are the NAFTA rules of origin? Well, we do know, we should say specifically, and here's where we get into, some definitions. Duty-free treatment is available to goods that, 1, are wholly NAFTA produced. What does that mean? Well, a good, quote, wholly obtained or produced in a NAFTA country or produced in a NAFTA country from NAFTA originating materials, or if goods do incorporate what are called non-NAFTA components, which is the case, I would say, in most situations. There are some non-NAFTA components. However, each such component undergoes a specific change in tariff classification as a result of production occurring entirely in a NAFTA country. So you see some of the basic definitions of the rules of origin right there. Let's see, do we have these details on this slide? There is a little line, maybe Sean could help. The slide cuts away. Okay. For some products, a change from one major heading to another is required. Remember that we cannot go into all the details of every rules of origin, but in some cases, the rules of origin differ depending on the product, particularly if we're talking about automobiles. Automobiles, that means cars, have their own separate rules of origin, and in fact are the subject of the most current negotiation between Mexico and the United States on what the rules of origin shall be for autos. We'll get into that detail in a moment. But know that for some products, a change from one major heading, and that's the tariff classification heading, to another is required to meet this definition. For others, a change between subheadings is sufficient, or, and that's a big or coming up, we have some really details. The assembly of such parts and components within NAFTA is sufficiently complex. We always want more assembly and components within NAFTA. We want them to be sufficiently complex to account for what's called 50% of the net cost, or 60% of the, quote, transaction value of the finished product. We refer to both the 50% of net cost and the 60% of the transaction value of the finished product as what's called regional value content, RVC. We want to see that the products obtain significant, sufficiently complex regional value content within NAFTA to be eligible for duty-free treatment. So that's the fundamental rule of origin. Well, what does transaction value mean? How do we calculate that? We'll get into a small calculation in a moment. Transaction value equals removing the price paid for non-NAFTA origin materials used in the production of the good from the price actually charged. So you want to get an actual transaction value by removing the paid price, the price they charged, the price paid, paid for non-NAFTA origin materials, removing that from the actual full price. So try to separate the non-NAFTA origin materials from the regional value content or the NAFTA content itself. We'll get into that a little bit more detail on how that works. Bear with me. The formula, as I mentioned, we have to do a small calculation in order to obtain a percentage of the RVC. And how do we get there? Well, we have a formula for calculating, again, the RVC, the regional value content, or the NAFTA content. We need to get a certain amount of NAFTA content. And using the transaction value method, which is the regional value content under the transaction value method equals the transaction value minus the value of non-NAFTA materials divided by the transaction value. And then, of course, we have to multiply that by 100 to obtain the correct percentage. Again, to repeat, the VNM is the value of non-originating material used by the producer in the production of the goods. Remember that, I've stated this before, but just remember, as it stands now, this may change to a situation, in some situations, particularly with autos that are presently under negotiation. But you should know for now that the regional value content using transaction value must be a minimum of 60%. That's 60% of NAFTA materials in order to obtain duty-free treatment. Now let's get into the other method, calculation, which you're also permitted to calculate to obtain your NAFTA origin materials, which is called net cost. Well, what is the net cost? Well, that equals removing the price paid for the non-NAFTA origin materials from the net cost to the producer of producing the goods. So, as opposed to the transaction value, which looks at the price, this one, price paid, this one looks at the net cost to the producer and subtracts the price paid for non-NAFTA origin materials from the net cost to the producer of producing the good. And in this case, the calculation may exclude sales, serving, royalty, shipping, and non-allowable interest costs. The formula for calculating the RVC using net cost method is very similar to the other transaction value RVC. In this case, it's the same, more or less same type of transaction. The RVC in this case equals the net cost, your figure above, again, minus the value of the non-NAFTA materials over net cost. And again, to obtain the percentage, we multiply that division by 100. The RVC in this case must be more than 50%. Important aspect of the two net cost and transaction value RVC method calculation is the exporter or producer may elect or choose the method to be used for each item and may use the most favorable method. So you, again, as the exporter or producer, you are in the best position to determine what your calculation would be, and you have the choice to calculate your RVC method using either your net cost or your transaction value. Since there is no way to memorize all the terms of NAFTA, you must know how to use these rules to determine whether your goods qualifying as originating. You need a system to review your company's products and NAFTA qualify them. I recommend the team approach to be the most effective way of qualifying your goods as NAFTA or not. You should include personnel from your accounting department, your sales, your purchasing, and your transportation or transport department, or whether or not you have a import, export, or international trade department. Now, let's get into the details, and I mean details, of the NAFTA Certificate of Origin. The Certificate of Origin, the CO, is a customs form. It is a legal document, though, that we'll begin to see. It is used to certify that goods qualify for duty-free treatment accorded by NAFTA. Well, it is the exporter who is responsible for filling it out, not the importer. This is a problem sometimes where the question I receive is oftentimes who is responsible. It is in general the exporter, because it is the exporter or the producer, as it may be, who is in the best position to determine its NAFTA content, not the importer. The exporter should or must send the CO to the importer, and then the importer turns around, and when he makes import, he must possess the CO at time he claims for duty-free treatment is made. Remember that there's entry documents, and on these entry documents that go to the various customs authorities in the U.S., it's Borders and Customs, CBP, Customs and Border Protection. And in those import documents is where the importer would request duty-free treatment, and generally that is accomplished by the fact that the importer possesses the CO demonstrating that the exporter has certified that the product under question that's being imported at that moment qualifies for duty-free treatment under NAFTA. However, you don't need, this is an interesting point, for those of you that are small importers or import a small or low value into NAFTA, you don't need a NAFTA Certificate of Origin unless if the product is valued less than $1,000. So for small entries, you don't need the CO, but you do need a written declaration on the commercial invoice, which is part of your import documentation, subject to another webinar, stating that the product is NAFTA qualified. So that makes it a lot easier for small shipments. All right, now we want to get into some of the rather complex, not complex, they're actually quite easy, but we could call them details. I have included in your package of slides the actual Certificate of Origin so that you may get a sense of what it looks like and that what we are talking about. You see, for example, here it is. the actual North American Free Trade Agreement Certificate of Origin. Again, as I've said, it is part of the U.S. Customs and Border Protection in the U.S. This is the U.S. form, and the form in Canada and Mexico is the same. U.S. Customs and Border Protection under the Department of Homeland Security publishes this document. And you will see from the perhaps strange the abbreviations 19 CFR 181.11, 181.22, that refers to simply the fact that this is a legal document falling under the Code of Federal Regulations of the U.S. government. So it's found at the Chapter 19, Section 181, if you will, of the CFR, Code of Federal Regulations. If you'd like to obtain a copy of that, of this document, Certificate of Origin, or especially a more recent one, you can find it there as well. Okay, so this is a picture, a view of the actual document itself, unfilled out. We will now walk you through what it is to be filled out. The CO contains 11 fields. We'll go back and forth so you can understand that. And it must be complete and accurate, or penalties. Oh no, penalties may arise for making it incomplete or inaccurate. You need to be careful. Again, it's provided by the exporter, I've mentioned that before, to the importer to support an importer's claim for duty treatment. This form can also be provided by the producer. In some cases, the exporter is not the first producer of the good, so in that case, the form can be provided by the producer for use by the exporter, who then sends it to the importer. There is a record-keeping requirement. You need to keep the CO on hand in your records for 5 years minimum in case there is a verification by the customs authorities. Okay, again, here is the actual document, which we will now go through field by field. I don't want to bore you, but I do want to not leave this program today without giving you an actual practical demonstration of how to complete the CO exclusively. So let's do that by going through each field. I can do that hopefully as quick as possible while still understanding how to complete the NAFTA Certificate of Origin. Field number 1. All you need to put in field number 1 is the exporter's name, the address, and the tax ID. So if you go back, you just see exporter's name, address, and email, and tax ID number in field number 1. Okay, basic. Field number 2 is referred to as the blanket period field. That means if the CO covers multiple shipments of identical goods, and that happens, as you can imagine, quite often. You have multiple shipments all the time, various periods of time of identical goods. You include a period covered by the CO. So you cover your blanket period that that the CO is valid for. However, this period may be no longer than 1 year. So if you go back, you will see the blanket period, field number 2, from month, day, and year to month, day, and year. And that's 1 year only. Okay. Field number 3. Provide the name, one moment, Address and tax ID of the producer. Producer. If exporter is the producer, state same. If producer is unknown, state unknown. So let's go back to 3. And as you will see, field number 3 should either have 1 or 2 words, either same or unknown. Sorry, wrong direction. Back. Okay. Producer, name, address, and email. Now, that's somewhat confusing. So you just want if it's the same as the exporter or if it's unknown, same or unknown, as the case may be, with respect to the producer, whether they're the same as the exporter or unknown, is all you need to put in there. And then a similar thing in 4, these are fairly obvious. This one, field number 4 is the importer name, address and email, and the tax ID number. It's field number 5, as you see, description of goods, where it gets more complicated and where mistakes are made. So let's talk about field number 5. Field number 5 is required a clear description of the goods, detailed enough to permit the tariff classification of the merchandise and to identify that the CO covers the merchandise included in a shipment. So you need to have some descriptors of the goods, such as the product number, commercial invoice number, airway bill number, or other unique identifier of the goods. Various product numbers are very helpful. Colors, size, any type of description, quantity, quality. These are all very important in field number 5 to give a clear description of the goods. Let's go to field number 6. In most cases, this field requires only the 6-digit tariff classification. That is based on the harmonized tariff schedule. Now, if you've never done this before, and I'm assuming maybe I should or should not, but I will, that you're not familiar with what's called the HTS. That is if you will, a schedule, a book of tariff schedules, tariff listings, or classifications. What this is essentially almost every product, as you can imagine, has a certain numeric classification, a certain class that the parties are required to assign to their merchandise, and the products enter into a country based on their classification, which allows the customs authorities to assess the appropriate level of duties. So that's a very important aspect of import-exporting, is what is your tariff classification of the merchandise, and you will find that in what's called the harmonized tariff schedules. Now, the importer may self-classify, meaning classify the product themselves, but this is complex. As I said before, there are so many multiple classes and classifications, and 6 digits, 8 digits, and up to 10 digits in some cases on very complex products. And I recommend, therefore, that you discuss this with your customs broker. A customs broker, if you don't know, is licensed by the customs, is a third party licensed by the customs authorities to give such advice under license. And I highly recommend that if you're not comfortable or you've never classified your products before, or if you have a question about classification, that you seek your customs broker to obtain such advice. For COs received from suppliers, you should review the classification always to determine that it is correct. It's very important that you have the correct classification at all times. Do not rely on supplier COs for the classification of your imports. Remember, you as the importer are entirely liable for the incorrect, inaccurate CO, and an incorrect classification may result in the incorrect rule of origin being applied to your goods or penalties, which we certainly don't want. So let's move on. It's a little bit more complicated with field number 7. Excuse me. Field number 7 are what we call preference criterion. The 4 most likely preference codes that should appear in this field are either A, B, C, or D. Now let's go up to what we mean by field number 7. Right, we did the description of goods, which you have your number 5, very specific description of goods. Your harmonized schedule, and this is, as we've talked about, field number 7, HS tariff classification number. Again, maybe you want to get your customs broker to help you. Now we get to preference criterion number 7, probably the most complex field to fill out and the one where I see the most mistakes made in my experience. Remember, as I just said, you should have either, in most cases, either an A, B, C, or D. Now let's talk about what those A, B, C, D, and E refer to. Here's criterion A. Criterion A signifies that goods are, quote, wholly obtained or produced in North America. This means that no non-North American materials were used in the production of the good. However, I should say that in today's global manufacturing, preference A almost never applies, particularly to industrial goods, and should be questioned. It may apply to, for example, agricultural goods in some cases that are wholly obtained and produced in North America. But again, those of you that are familiar with various supply chains in today's global manufacturing, it's very difficult for one product to be wholly obtained or produced in any one country. Today's industrial goods, some are produced in multiple countries and assembled along the supply chain. Preference B, therefore, is the most commonly correct that I see in my experience criterion. This code is for goods that satisfy the North American rule of origin as a result of production in North America. Remember, that means each component undergoes a specific change in tariff classification as a result of production occurring entirely in a NAFTA country, or I should also say it satisfies the regional value content methodology. And remember what we talked about, the net cost calculation of 50%, or the transaction value of 50%, and the net cost method of 60% of NAFTA materials. Preference C, a good is considered qualifying if that good is made up of entirely components that qualify in their own right, and no non-originating goods, quote, are used in the production of the good. For example, if a good has 3 components, all of which have been certified as NAFTA priorly, based on B by the supplier, the finished good therefore qualifies as NAFTA origin based on preference criterion C. So preference C is often used when you have various components that have already been qualified into a finished good. Then you can qualify the finished good as well. Preference D, getting on with it, should only be used for goods that are assembled, disassembled, or incomplete, or the classification is the same HS as their parts. In these cases, tariff shifts are impossible, and the merchandise will qualify if it satisfies only the regional value content requirements, as we've discussed, transaction value or net cost. So that is for preference, that is to go back to give you a specific understanding, that is field number 7, where you should only have, in general, A, B, C, or D in that preference criterion field number 7. Let's talk about 8, 9, and 10. Field number 8. You only answer either yes or no. And it would be yes if you are the producer. This is a question of how do you know the origin of the products listed in 5 are originating. How do you know? Well, you know either because you are the final producer, you're in the best position to know whether or not it's originating. So you have to put a yes and then add 1, 2, or 3, depending on how you know the product listed in field 5, that's your description field, are originating. Well, you put it 1, yes, you put a yes if you're the producer, and a 1 if you just know it is NAFTA eligible. Okay, you just know. State number 2, if you have a document from the producer that it is NAFTA eligible, or 3, by far the best, you would also put, not also, but you would put a 3, yes, 3, if you have a NAFTA certificate of origin. If you're not, finally, in field 8, if you're not the producer, you would just put a no. The problem is, and we'll see this in a moment, many unfamiliar parties, importers or exporters, I should say, think that it says producer, and therefore they identify the actual producer. That's not what it's asking. It's only asking if you are the producer, yes or no, and then a 1, 2, or 3 showing how you know that the product is originating. Field number 5 says, if you use the RVC method, remember the regional value content method, you state either NC, net cost, or no for all other situations. For example, if you use RVC method, but you use transaction value, the other one, as opposed to net cost, NC, just put a no for all other situations. So that field number 9 should either have a NC, net cost, yes, and I shouldn't say yes, I should have an NC or a no if you did not use a net cost. Field number 10, let's go back just to make sure that you fully understand where we're at on the actual document. Field number 10. Remember, I just go over it more in detail now that we're looking at the actual, the actual document itself. For field number 8, I went over. Remember, don't put the producer there. That's very challenging for some. You only put yes or no and how the product qualifies, 1, 2, or 3. Net cost, you don't, if you use net cost, you put yes, net cost. Or no, you don't put the actual net cost figure there. We'll go over that in a moment. Now, number 10 should be self-explanatory. The country of origin can only be one of 3. That can only be U.S., Canada, or Mexico. Be careful about that one for obvious reasons. It can only be one of 3. Going back to our slides. Sorry, went too far. We just did field 10. Then finally, field number 11 is also important. Excuse me again. Field number 11 means it must be signed by an authorized person who has personal knowledge of the origin of the goods. So you must designate, I should say, authorize someone in your organization who will have personal knowledge of the origin to sign the certificate of origin. Okay, common mistakes. I've mentioned a few of these already, so I'm going to try to go quickly. Time is running short, and I want to continue, finish the presentation, and still give you take some questions. Field number 5, providing inadequate description of goods. Be specific, provide as many identifiers as possible. Field number 6, putting the incorrect tariff classification. Proper tariff classification is essential. Tariff classifications can go all the way up to 10 classes and headings and subheadings. So I recommend consulting a licensed customs broker to help you with your tariff classification. Field number 7, many cases the mistake is made selecting the wrong preference criterion. Each qualifying import must meet one of the criterion, in general, A through D. There are other ones, but most of them are A through D. Field number 8, the mistake that is made is identifying the actual producer of the goods. I mentioned this before. You don't need to identify in field 8. You've already done that, hopefully. Well, no, you've already done that maybe in the field number 2 or not. But field number 8, you just put yes or no, and if it's yes, how you know. Sorry, I should just say whether how you know. Field number 9, failure to properly enter the value of the product. Again, you don't have to put the value of the product there. Do not enter the dollar value of the product. Enter no or NC if you use regional value content, RVC, to calculate whether your product qualifies as originating. Field number 10, listing non-NAFTA products is a mistake. It should only put in Mexico. You should only put in Mexico, Canada, or US. Field number 11, again, we just went over this, certified by an unauthorized person. That would be a mistake. Certified, meaning they must be certified under oath by a person with personal knowledge to verify the origin of the goods. Those are the main mistakes. Now, how does customs determine this, whether there's mistakes and what are the penalties? Well, the standard of care, remember this, there's a reasonable care, quote, requirement in qualifying your goods. So what is reasonable? The failure of an importer to exercise reasonable care may result in fines, loss of trade preferences, shipping delays, and in some cases, the exclusion or seizure of the goods. So we don't want that to happen. Therefore, remain compliant. Your company may have been importing a product for many years, assuming that it qualifies, then discovering through a customs audit that the goods do not qualify. In such cases, you will be forced to pay back your duties and penalties. Okay, origin verifications. How does the customs authorities verify? A customs authority may conduct verifications of the exporter or producer to determine whether goods qualify as originating. Written questionnaires and verification visits. You will first receive a questionnaire if customs wants to verify your claim for duty-free treatment or originating NAFTA products, or they may decide to actually come verify themselves by visiting your office. Prior to this visit, the customs authority must provide written notice of its intent to conduct a visit. Advanced rulings. Again, companies may self-classify their goods as NAFTA in origin, but the classification process, as I've mentioned, is complex and confusing for many importers and exporters. Therefore, the only way to be certain is for importers, exporters, and in some cases producers to obtain an advanced ruling on the origin of the goods. I highly recommend this, especially for those of you that are new to NAFTA trade. You may want to receive an advanced ruling from CBP that your products qualify, or what the classification of your products are as well. An advanced ruling is a written binding document from the customs authority concerning specific NAFTA questions regarding future imports. Finally, conclusions. Again, some repeating of facts here for you to remember. NAFTA was created more than 20 years ago to expand trade between U.S., Mexico, and Canada. By easing trade between 450 million people, roughly, in 3 countries combined, NAFTA more than quadrupled trade in 20 years' time. Each North American country undergoes tariffs on imports, quote, originating, end quote, in the other NAFTA country. NAFTA Rules of Origin contains the criteria to determine if, quote, originating NAFTA and therefore eligible for duty-free treatment. Exporter must accurately complete a certificate of origin to allow the importer to qualify for these benefits. Parties often make mistakes on the CO, such as incorrectly qualifying the goods, providing inadequate product info, and providing the wrong contact information. Civil, criminal, and administrative penalties may be assessed for falsely claiming preference. To be sure of your origin of goods, you should apply for an advanced ruling from the customs authorities. Customs authorities may issue written questionnaires or make visits to verify whether the good qualifies for preference. And then finally, I recommend highly, again, that you consult with a customs broker before you begin to either self-classify or self-originate your products.